and welcome to Managerial Accounting. In this first chapter, we're just going to kind of do a broad overview of what exactly managerial is and what it encompasses and how it's a little bit different than financial accounting. So we'll go ahead and start with a definition of managerial accounting. As you can see there, it's a field of accounting that provides economic and financial information for managers and other internal users. Okay, so to understand the kind of information that managers need, let's look first at their primary responsibilities. So managers have three primary responsibilities you can see here. They have planning, directing, controlling, and then integrated throughout all of those is the decision making, which is identifying alternative courses of action and choosing among them. So let's take a little bit closer look at each one of those. So planning, quite simply, involves setting goals and objectives for the company and determining how best to go about achieving them. So for an example, a goal for a company might be to maximize short-term profits and increase market share. In addition to planning for the future, managers must oversee day-to-day activities to keep the organization functioning smoothly. Managerial accounting data such as daily sales reports are often used in this type of day-to-day decision-making. In carrying out the control function, managers look to ensure that the plan is being followed. Feedback by which signals either operations are on track is the key to effective control. A performance report compares budgeted to actual results. So the work of management, which is known as the planning and control cycle, can be depicted as shown, which we see here. The process is a continuous loop in many organizations. Once the plans are made, they are implemented. The controlling process then begins. And it starts with measuring actual performance and then comparing those results against planned performance. Corrective action may be necessary if actual results differ significantly from the plan. In some cases, new information may result in altering the plan before the cycle is repeated. Note the decision-making is involved in all management activities. So let's take a look at the differences between managerial accounting and financial accounting. So if we look here at the users, you can see that financial accounting reports are prepared for external parties, whereas managerial reports are prepared for internal users, those with inside the organization. Now the emphasis for managerial accounting is on the future, whereas, as you recall, in financial accounting, it was a historical perspective, so we were summarizing past transactions. If we look at the relevance of data, financial accounting should be objective and verifiable. Now, management accountants focus on providing relevant data, even if it isn't completely objective and verifiable. There's less emphasis on precision with managerial accounting, and it's a higher, stronger emphasis on timeliness. So financial accounting focuses on precision when reporting to external parties. Managerial accounting aids decision makers by providing reasonable estimates more quickly rather than waiting for precise data later. If we look at segments of organizations, financial accounting is going to be focused on reporting for a company as a whole, the entire organization, whereas managerial accounting focuses more on the segments of a company, like, for example, product lines or sales territories, divisions, departments, etc., something like that. Now, generally accepted accounting principles applies to financial accounting. It has to conform to GAAP, whereas managerial accounting is not bound by GAAP. So we can prepare any kind of report that we feel will help us make better business decisions. It does not have to follow any prescribed format or GAAP. And finally, managerial accounting is not mandatory. It's not something that's required to be used, whereas financial accounting is mandatory because we have various outside parties that are going to require periodic financial reporting. Okay, so let's take a quick look at the organizational structure of a company, a corporation. Now, most corporations are too large to be governed directly by their stockholders, so they elect a board of directors to oversee the company. Now, the board only meets periodically, so they actually hire a chief executive officer or CEO to manage the company on a daily basis. The CEO then hires other executives to run other aspects of the organization. For example, the COO, who is the chief operating officer, and the CFO, or the chief financial officer. The COO is responsible for the company's operations like research and development, production, and distribution, whereas the CFO is responsible for all of the company's financial concerns. Now, the treasurer and the controller report directly to the CFO. The treasurer is primarily responsible for raising capital through issuing stocks and bonds and investing funds, whereas the controller is usually responsible for general financial accounting, managerial accounting, and tax reporting. Now, companies that are traded on the New York Stock Exchange are required to have an internal audit function. So the role of the internal audit function is to ensure that the company's internal controls and risk management policies are functioning properly. And the internal audit department reports directly to a subcommittee of the board of directors called the Audit Committee. The Audit Committee oversees the internal audit function as well as the annual audit of the financial statements by independent CPAs. Now, I think it's important to note here that both the internal audit department and the independent CPAs report directly to the Audit Committee here for a very important reason, which is to ensure that management doesn't intimidate them or bias their work. So if there was something going on in the organization, perhaps that was being driven by a CEO or a CFO, there's an outside path for companies to take, or not companies, employees to take to report those without being intimidated by their bosses. So let's take a quick look at the changing role of management accountants. Now, management accountants don't perform as the typical routine mechanical accounting tasks that you might associate with them with doing. So in the past, you would say accounting and people would say scorekeepers or bean counters because they spent most of their time recording transactions. However, now management accountants act more as internal consultants or business advisors. They still need to make sure, though, that the company's financial records adequately capture economic events. They help design information systems that capture and record transactions and make sure that the information the system generates is accurate. They need to know what transactions to record, how to record them, but they are typically freed from the routine mechanical work because of technology now, and they spend more of their time planning, analyzing, and interpreting accounting information and providing decision support for others within the organization. Actually, management accountants are now often referred to as financial advisors, business partners, or analysts. There are a variety of skills that managerial accountants should possess. Of course, they need to have some basic accounting knowledge, that's assumed. It's also beneficial that they have general business knowledge because, again, now we're collaborating with others in the organization, maybe someone in marketing or research and development. So we have to have an idea about how their department operates and how they're operating as well. They need to have good written and verbal communication skills. Microsoft Excel skills come up repeatedly as a vital skill for accountants. Good analytical skills, obviously, to analyze and interpret and understand information. And then, of course, the ability to work on a team is another vital skill for management accountants. So the Institute of Management Accountants is a professional organization for management accountants. The mission of the IMA is to provide a forum for research, practice development, education, knowledge sharing, and advocacy of the highest ethical and best practices in management, accounting, and finance. They also want to educate society about the role management accountants play. And they also issue the Certified Management Accountants, which is the CMA certification as opposed to the CPA, Certified Public Accountant designation. And it's quite similar. You have to pass a rigorous exam, maintain continuing education, yet the CMA focuses on managerial accounting topics, which are similar to what you will find in this particular textbook. Now, while most employers don't require the CMA designation, it is certainly helpful. Now, management accountants, as do most accountants, continually face ethical challenges. So the IMA has developed principles and standards to help management accountants deal with these challenges. The principles and standards remind all management accountants that society expects them to behave with the utmost of highest ethical behavior. And the statement on ethical professional practices requires that management accountants do the following. They maintain their professional competence, that they preserve the confidentiality of the information they handle, that they uphold their integrity, and that they perform their duties with credibility. Now, if management accountants do encounter some unethical behavior, there are a series of procedures that the accountant should follow or consider the following steps. So they should discuss the unethical situation with their immediate supervisor unless their supervisor is involved in the unethical situation. If so, then they should go to the next level higher, managerial level higher. If their immediate supervisor is the CEO, they should notify the audit committee. They could discuss the situation with an objective advisor like the IMA ethics counselor. The IMA offers a confidential ethics hotline to its members, so they could use that, or also consult with an attorney regarding their legal obligations and rights. Next, you can see here that there is a difference between unethical and illegal behavior. Not all unethical behavior is illegal, but all illegal behavior is unethical. A management accountant who commits an illegal act is violating this ethical standard. So in other words, ethical behavior encompasses more than simply following the law. The IMA's ethical principles include honesty, fairness, objectivity, and responsibility, and those principles are much broader than what is codified in the law. So there have been some regulatory and business issues that have transpired over the past 10 or 15 years, and we're going to delve into each one of those in greater detail here. But that would include Sarbanes-Oxley, the IFRS, the International Financial Reporting Standards, the Extensible Business Reporting Language, XBRL, sustainability in a shifting economy. So let's go directly to Sarbanes-Oxley here. Now, the purpose of SOX or Sarbanes-Oxley is to restore trust in publicly traded corporations, their management, their financial statements, and their auditors. SOX enhances internal control and financial reporting requirements and establishes new regulatory requirements for publicly traded companies and their independent auditors. Now, these Sarbanes-Oxley Act was a result of corporate accounting scandals that happened, such as Enron and WorldCom. So the U.S. Congress stepped in and enacted the Sarbanes-Oxley Act of 2002. Now, it requires that the company's CEO and CFO assume responsibility for financial statements and disclosures. The CEO and CFO must certify that the financial statements and disclosures fairly present in all material respects the operations and financial condition of the company. They must also accept responsibility for establishing and maintaining an adequate internal control structure and procedures for financial reporting. The company must have its internal controls and financial reporting procedures assessed annually. It also requires that the audit committee members be independent, so they receive no consulting or advisory fees from the company other than for their service on the board of directors. One of the members should also be a financial expert. And the audit committee not only oversees the internal audit function, but also those independent CPAs. SOX also doesn't allow CPA firms to provide certain non-audit services like bookkeeping and financial information systems design in the same period when they're providing audit services. Lastly, one of the biggest penalties that's assessed in Sarbanes-Oxley is for white-collar crimes like corporate fraud. So the penalties include both monetary fines and potential imprisonment for those who enact it or participate in it. Now, as a result of the increased globalization of our economy, there has been a need or a desire for there to be consistent reporting standards for all companies in the world. Now, the International Financial Reporting Standards, or IFRS, has been trying to converge with GAAP for quite some time now so that we could have one standard worldwide. This is still in progress. I'm not sure. They had initially hoped to have things implemented by now, but I think there's some hiccups. I heard someone say a few months ago that they're not sure that there will ever be convergence. So I would say stay tuned here and we will see what happens. Doesn't apply to management accounting though. Now, this extensible business reporting language enables companies to release financial and business information in a format that can be quickly, efficiently, and cost-effectively assessed and sorted and analyzed over the internet. So what it does is it uses a standardized coding system to tag each piece of reported financial and business data so that it can be read by computer programs rather than by human eyes. So for example, sales revenue would be tagged with the same code by all companies so that a computer program could extract sales revenue information from individual company or selected group of company. This would allow computers to sift through financial reports and extract only the information that is needed. Now, obviously, it would save a lot of time, allow managers to quickly compare the results to other companies, allow investors and managers to kind of extract the information that they need, and promote more consistent use of terminology. Now, the SEC was looking at requiring all companies to file their financial reports using XBRL. And this became required in 2011 for all companies to start using that format. Now, some trends that are affecting management accounting are sustainability, social responsibility, and the triple bottom line. So sustainability is defined as the ability to meet the needs of the present without compromising the ability of future generations to meet their own needs. Many companies are trying to look at becoming increasingly more sustainable. So what they can do to protect natural resources or to do something that's not going to harm the environment, that's certainly a focus under sustainability. Social responsibility says essentially that a business not only should be focused on making profits, but also look at things that might benefit people as well in their business. So perhaps you've heard of Tom's Shoes and you buy a pair and they donate a pair. That would be an example of social responsibility. Or Home Depot is only sourcing materials that are replenished and sustainable. That would be another example. The triple bottom line is a relatively new concept which recognizes that a company's performance should not only be viewed in terms of its ability to generate economic profits, like we were talking about with social responsibility, but also by its impact on people and the planet. So we're combining all three of those. So sustainability could be viewed in terms of three interrelated factors that influence a company's ability to survive and thrive in the long run, which include people, profit, and planet. Other trends happening right now is typically the North American economy is shifting away from manufacturing towards more of a service economy. So we have healthcare, communication, transportation, banking, rather than typical manufacturing type jobs. A lot of those manufacturing jobs have been replaced by technology anyway. So since we've had a change from less manufacturing towards service and retailers, management accounting has had to adapt their systems to help those types of companies also interpret cost information and help them make good business decisions. Now, as the barriers to international trade have fallen, this means that there is even more competition than in the past. So managers need more accurate and timely information to help them make wise business decisions. The speed at which business happens today is quite quick. So companies can't afford to wait, and they can't afford to make decisions without good data and good information. So detailed, accurate, in real-time cost information has become a necessity for survival to many companies. They can also learn new management techniques from their competitors as well. So perhaps we may observe some international competitors doing something and we want to adapt that. So with the advent of technology now, the accounting profession has developed these accounting information systems or advanced information systems. And through the use of technology, we've been enabled to develop quite a few new things. We'll talk about all four of these here in just a minute. The Enterprise Resource Planning System, or ERP system, Lean Production, Just in Time, which is JIT, or Total Quality Management, TQM. So we have a lot of acronyms going on there. Enterprise Resource Planning, or ERP systems, is one system that integrates all companies' functions. So it will tie human resources to production. Okay, so I was saying ERP systems integrate all of a company's functions like human resources, production, accounting, sales. All of those systems are tied together and integrated. Now, the big benefits for ERP systems, because they're quite expensive to set up and develop and get running, but it does help companies streamline their operations, which helps save money. It helps companies respond quickly to changes. So, for example, a change in sales will automatically filter through the ERP system, through purchases, production, shipping, and the accounting systems. And then they can replace different software systems. So a company will then be using that one system again to do payroll, shipping, production, whatever it might be. They are really a necessity for any large company running to be most efficient as possible. And companies will look at the cost. So lean thinking is a new philosophy and a business strategy that companies are using to operate without waste. So if they can eliminate waste, then the lower the company's cost should be. With lower costs, companies are better able to compete. So one primary goal of a lean production system is to eliminate the waste of time and money that accompanies storing large inventory. If you think about it, inventory takes time to store and unstore, and then the cost of holding inventory can add up to 25% or more of an inventory's value. Also, inventory that's held too long can become obsolete because of changing technology, consumer tastes become damaged, etc. So companies that are advocating lean operations tend to adopt something called just-in-time, or JIT, inventory philosophy that was first pioneered by Toyota. So what happens is they manufacture a product just in time to fill customer orders and no sooner. So companies are able then to substantially reduce the quantity of raw materials and finished product that they keep on hand, which reduces storage costs and associated costs like security, utilities, shrink, and handling and labor costs. So since companies are making inventory just in time to fill customers' order, then they're better able to produce a quality product quickly. And then lastly here, we have something called total quality management. So all companies, not just lean producers, have to deliver high quality goods and services to remain competitive. So total quality management is one key to succeeding in a global economy. The goal of TQM is to delight customers by providing them with superior products and services. So every company is going to focus in on each business function and examine those activities and work to improve performance by continually setting higher goals. So that continuous process performance management. and discuss how the costs associated with their level of quality and improvement initiatives all work together. And then if you'd like at the end, well, that concludes this particular chapter. Thank you.